So Lisa was painting the picture there that maybe corporate debt that is slightly less risky has been outperforming, but you're actually starting to see on the back of the Fed rate cut that investors are getting pushed down even further down the quality curve to a certain extent.
That's exactly right. I think one thing that's really key about the cut is that for corporations, that's a sign that the music can keep playing. And so if you are confident in sort of corporate earnings and corporate leverage, which many investors are right now, you could maybe go and take a little bit more risk. Look at those triple B bonds, triple Cs even if you play high yield, because those are kind of where we're seeing a little bit of underperformance right now. So maybe you can buy right now on the cheap.
And good, luckily for a lot of investors, there's a lot of supply to choose from as well, because July was a big month for high yield debt issuance.
Yeah, it's been very surprising. Typically you expect a bit of a summer slowdown, some bankers on vacation, but we have really not seen that. One of the busiest Julys on record. And what we're hearing from our banking sources is that August is going to be really big as well.
Okay, interesting. Tell us the enticement towards high yield or higher risk. Of course, it's the yield, but I didn't realize that perhaps the maturities are slightly distinct as well.
Yeah, so one thing that is very key about high yield, investment grade, you think about these really long-term maturities, these 30-year bonds, and those do really well in times of lower rates, so maybe you look there. But if you want a little bit of a shorter maturity, you're lending to a risky company, that's typically what you see in high yield. The average maturities are much lower.
How much lower are we talking about here?
So, a lot of times you'll see issuance in high yield in more of the 3 to 5 range. Very rare that you see a bond longer than 10 years. Whereas investment grade, there's a huge pension bid, so a lot of companies are enticed to issue all the way out the curve.
Can I ask, and I know, of course, you focus on the United States, but given that yields are so much lower in Europe and in Japan, are we starting to see an interest in other foreign currencies, or is it just too difficult given the FX swaps?
Yeah, the FX swaps are very complicated and they change very quickly, so there's a lot of buyers coming in and out of the market. Right now, it's still pretty much the US is the only game in town, so we do see a lot of bid from, the Japanese insurance buyer maybe, or Europe, because if you want some yield that's positive, you're probably going to have some US assets.
When you talk to money managers like T. Rowe Price, like Goldman Sachs Asset Management, are they giving any indication that they're nervous about how things have gone on for this long and how the music might stop at some point? I mean, I know the Federal Reserve cut interest rates, but Jay Powell was very reluctant to say what the outlook is. He wouldn't say that we're at the beginning of a long cutting cycle either.
Exactly. I mean, I think the thing that I hear over and over again is we have to be discretionary. We have to look and really like the credit and understand the story, because there are going to be these bumps in the road. You're seeing that right now in energy. Just a lot of companies really struggling. Crude is lower again. So maybe you don't look there. Maybe you play a safer industrial bond or something like that instead. So they say it's about credit picking.
Credit picking. Where in the credit rating areas have really outperformed since Wednesday?
Yeah, it's been higher quality is still really in favor. Triple Bs have done well this year, but at the same time, we are seeing a little bit of caution. And in terms of lower rated debt like triple Cs, that's where we're still seeing some underperformance right now.
And when you talk about credit picking, what are these asset managers saying in terms of sectors versus geographies versus just the brand names of companies? I mean, there are certain companies that you feel comfortable going with and others that you want to steer clear of.
Exactly. I think post-bank earnings, a lot of investors are looking at bank bonds right now, feeling really feeling good about asset quality and just some of those big metrics that they look for there. That's very popular. If you want to go, very safe, it's often those counter-cyclical type industrial names you might look at. And when you think about what's out of favor right now, it's probably oil, it's probably retail, kind of same old story we've been hearing.
Is there a cutoff point? I mean, we haven't seen a cutoff point with negative yielding debt in an awful lot of the government bonds and even in corporate bonds. But is there a cutoff point when a triple C just cannot be appetizing anymore?
I'm not sure we're seeing it yet. At some point, when things are really risk off, what do people sell? They sell triple Cs. That's kind of a leading indicator for us here. But so far, it seems like people are willing to go down in credit quality if it means getting a little bit more yield.